What's up guys, it's Christian. Welcome back to another video. Today we're going to talk about Russia and OPEC and a statement they put out last week saying they're going to be decreasing their output by 1.1 million barrels a day. This isn't the first time that OPEC has cut oil production, but this change in global oil supply will likely affect oil prices, which means it'll affect you and it gives you an opportunity to make money. If you aren't familiar with OPEC, OPEC stands for the Organization of Petroleum Exporting Countries. It's a group of countries around the world that all produce oil and work together to control the supply and consequently the price of oil. Big players in OPEC include Iran, Iraq, Kuwait, Saudi Arabia, the United Arab Emirates, and a collection of other oil-producing countries across Africa and South America. In the past year, OPEC has done very well since Russia attacked Ukraine in February of last year. When Russia attacked Ukraine, they cut off their oil supply to the rest of Europe, and with most of Europe's oil coming from Russia, the shutdown in supply was a major problem for them. This new demand found its way to OPEC, which increased their demand and consequently upped the price of oil remarkably. Following Russia's attack on Ukraine, the price of oil increased to $120 per barrel, up from about $70 in December of 2021. Consequently, as the price of oil increased, OPEC was able to profit a lot more due to their increased demand in oil and the rising price in oil itself. However, throughout the summer of 2022, and with the warm winter this past year in Europe, the demand for oil has decreased and consequently the prices decreased as well, from the high of $120 about a year ago to about $80 a few weeks ago. In response, OPEC agreed to decrease their combined oil production by 2 million barrels a day in October of 2022 to decrease supply and push prices back up to where they once were when Russia initially attacked. More recently, with increased inflation in the US, the Biden administration and other allied countries have pushed for increased production of oil from OPEC and other global oil producers to decrease the price of gas this summer. However, the big news this week is that OPEC and Russia agreed to collectively reduce oil production by 1.1 million barrels a day, in addition to their 2 million barrel a day decrease from October of last year, with both Russia and Saudi Arabia agreeing to decrease oil production by 500,000 barrels a day per country starting in May, and represents about 1% of total oil production. According to Alexander Novak, the Deputy Prime Minister of Russia, this cut is primarily aimed to ensuring the stability of the energy sector in response to the volatility and unpredictable economic situation caused by increasing global inflation and the collapse of banks across the United States and Europe. Additionally, Saudi Arabia had a $1.5 billion in Credit Suisse, the recently defunct Swiss bank, which was an investment that was nearly completely wiped out when Credit Suisse fell last month. Russia and Saudi Arabia's concern for the stability of the energy and banking sectors is not completely unfounded, as after SVB fell, the price of crude oil fell dramatically, thus providing the rationale needed for them to cut oil production to increase profits, as we've seen. In response to the cut, the White House pushed back saying, "We're focused on prices for American consumers, not the price of barrels, and prices have come down significantly since last year, more than $1.50 from their peak last summer." However, this did not seem to calm markets as the price of oil and oil-producing companies skyrocketed following this announcement from OPEC. Brent crude, the major benchmark for worldwide oil purchases, is up over 6%. The major oil producers have also seen price increases, with BP increasing over 4%, ConocoPhillips nearing 7%, ExxonMobil around 5%, and Shell increasing over 5% as well. Thus, the surprise move by OPEC has had dramatic effects on the market already. And it's clear to see why. If you have decreased supply with no change in demand, you're obviously going to have an increase in price according to simple economics. In addition to the increase in price of oil itself, the companies surrounding oil production, BP, ConocoPhillips, ExxonMobil, etc., are also expected to see price increases. As the asset that they're making, the oil, goes up in price, their profits should correspondingly also increase, thus increasing the valuation of the whole company and effectively the stock as a whole. To take advantage of the situation, like any other geopolitical event, we need to determine first the sector that's affected and the direction that sector is going to move. In this case, it's a pretty simple calculation, as the price of oil is primarily what we're talking about. We know the oil sector is predominantly the area we want to focus our research and efforts in. But assuming it's clear that oil and the oil-producing companies are the sectors we need to focus our attention in, the next question is, which direction will the price go? So looking at it from simple supply and demand economics, the 1.1 million barrel a day cut coupled to the 2 million barrel per day cut in October means the global supply of oil will decrease in the coming weeks. In addition, summer is coming, which means increased travel and thus increased demands for oil. According to simple economics, we have decreased supply through oil cuts and increased demand through travel, which consequently means that the price of oil will likely increase going into summer and fall. So to profit from the situation of probable increasing oil prices, there's two main areas or ways that you can profit from it. The first is you can profit from the price of oil itself, and the second is you can profit from the increased valuations of companies in the oil production sector. If you want to trade on the price of oil itself, the two main stocks you could look into are ticker symbol OILK, which trades the price of oil itself. Conversely, if you're interested in higher risk, high reward options, ticker UCO will provide 2 times leverage to the price of oil, meaning that the price of oil increases 2%, you should see a 4% increase in your stock valuations. By trading the oil price itself, you gain direct exposure to the price of oil without involving all the risks associated with oil producing companies. However, this option is slightly more risky as the price of oil is highly volatile and has large fluctuations in price, compared to oil producing companies that have assets that kind of buffer the stock price, so you don't see the large fluctuations in volatility as you might see with the price of oil itself. If you're interested in investing into the more diversified option of oil producing companies, the 2 tickers I suggest you look into are Gush and Dig. Through these leveraged ETFs, you'll be able to gain a 2 times return compared to the underlying stock, maximizing your profit potential. Through trading ETFs that track oil producing companies, you'll be able to get a higher degree of exposure to a diversified portfolio that will provide higher levels of stability compared to the underlying oil price. However, by trading oil companies, you're accepting the risks associated with trading with any company, such as their liabilities, the risks of regulation, and other issues that might befall them. But whether you choose to trade the price of oil or oil producing stocks, you can use ETFs that are leveraged to maximize your potential profits while also increasing your risks. So it's kind of a risk and reward situation, which is why you need to always be diligent when making any investment decision and thoroughly research every option before making a trade. But anyways, today we talked about how OPEC has increased their production cuts, how these changes to oil supply will affect the price of oil, and potential ways you can profit from all of this using leveraged funds. I hope this video was educational and you learned something from it. If you did, please consider subscribing and liking. It really helps me out. Thank you so much for watching. I appreciate you. I'll see you next time. Thanks.